Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the stocks that has become very unloved in the market is Disney. The stock is trading at $84 a share. The market cap has fallen to about $154 billion. But this is still a very profitable company and a company that I think has a brighter future than a lot of people think. So today I want to cover why I think this could actually be a multi-bagger stock. The stock could go up 5 to 10x over the next decade if the company gets its strategy right. So that's what I'm going to cover today. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And for a full deep dive on Disney and their strategy long term, I've got a link in my show notes to a big article I did on asymmetric investing. So check that out. And I'll cover a few of those things here. But I want to start with the company's recent results and just show the trends. This is a quick look at Disney's media and entertainment business. And you can see that linear networks are in decline. They've been in a state of decline for years, but that's really starting to hit the company's bottom line. This blue bar on the bottom, operating income, you can see down about $600 million. Direct to consumer, that includes the streaming business, is still also losing money. So becoming a much bigger business, $5.5 billion in revenue. And that's before price increases that are going to go into effect in the next couple of months, but still losing money. And this content sales and licensing is also still losing money. That's partly because of weaker theatrical releases. You could say also a decline in the company's quality of pictures. But the general trend here is that the cash cow of the linear business is starting to really decline quickly, and direct-to-consumer and streaming has not made up for that quite yet. I'll get into what I think Disney's going to do in the future. These are the trends in those results. This top chart here is the operating income loss by quarter. You can see that those losses are getting better since the fourth quarter of 2022. And that's in part because costs are starting to come down. Costs are down $400 million and revenue is going up slightly. So we should see the company move to break even or a little better than break even in the next year, I would think, but it's kind of a long road ahead. And what's really driving this is increased prices, increased revenue in the streaming business. Disney Plus is the one that most people probably know, but that also includes Hulu and ESPN Plus. ESPN Plus is the one that Iger has said is going to go over the top for the whole ESPN product. We'll see exactly what that looks like, but these are really big businesses. They're just not profitable yet. One of the things that I want to go over is the operating income that's coming from parks and experiences, because this is really the foundation for Disney. And you can see that since 2015, results have steadily been getting better. There's obviously a big outlier here with the pandemic in 2020 and 2021, but we can probably expect to see more operating income in fiscal 2023 because all of their resorts are going to be open now. Particularly the Shanghai Disney Resort is going to be the one that was not necessarily fully operational last year. Operating margin of 28%, just a phenomenal business. And that's really the core for Disney. Think about a business that could do about $10 billion in operating income this year. That's actually not all that unreasonable for the entire market cap of Disney, $150 billion, about 15 times the parks and entertainment operating income. So that's a really good foundation to be building from. The question is, what do you do with content and streaming? And here's where I think there are some logical moves that they're going to make. And Iger has talked about a few of these. One, the big tentpole pieces of content, Marvel, Star Wars, Pixar, and then I lumped Avatar in there. Those aren't going anywhere. Those are going to be foundational for Disney for years to come. The other thing that probably isn't going to go anywhere is this low-cost content studios. The channels themselves might go away, but the content studios, this is something that Iger has said over and over, that they're going to focus more on what they call general entertainment content. That's basically this end of what I call the smiling curve. On the left to right here is scale. So these are big tentpole pictures, things that make billions and billions of dollars and everybody knows by name. And these are the smaller things. So more niche services, the kind of thing that you would pop on if you're just tuning into Disney Plus or Hulu, something like that. What's probably going to be sold or divested is assets that fit anywhere in the middle. So ABC is a big one. Disney owns ABC. I don't think that really makes a lot of sense for them to own that in the future of streaming. That could be an asset sale that generates quite a bit of cash for Disney and allows the company to either pay down debt or invest in other strategic assets. And keep in mind that streaming is really the future for Disney. So as the linear business declines, I think we're going to see Disney exit a lot of that linear business. So ABC is a perfect example of that. Maybe even the linear version of ESPN. And then they're going to keep the streaming rights to a lot of these things. So what does that look like and why does it make sense? Well, again, I go back to this smiling curve. Typically on the internet, what happens is the value accrues to the companies that are big and have a ton of scale, or the companies that are very small. So this would be like YouTube creators in the top left, like this channel here. I can start this channel, and with just a microphone and a camera, at the other end of the spectrum is going to be the giants like Netflix. Netflix has 238 million subscribers and can command about $15.50 on average per subscriber. That's in addition to any advertising revenue. It's not a coincidence that Disney has said it's going to combine all of its apps into one app, and that will allow the company to probably pump this price up a little bit more and lump these subscribers together. So they're not going to be, so there's overlap between these three numbers, but they are going to probably have the second biggest streaming service of any company and may even have a higher price point than Netflix on a per subscriber basis. That's a great position to be in because then you can continue reinvesting in the business and try to move up this smiling curve. The companies that are in trouble are the ones that have fewer subscribers and don't have a lot of pricing power. Peacock is essentially giving away their product, and I don't think there's a lot of traction there. Max is now kind of diluting itself by licensing some of its own content to other streaming companies. So there may only be a couple of winners in streaming. I think Disney wants to be one of those. And the strategy is to have Disney tentpole content in the top right of that smiling curve there, have sports be another draw, and then Hulu is going to be the general entertainment side, the thing you just put on when you just want to watch something. I think that's really the strategy. From a monetization standpoint, this gives Disney a lot of flexibility. The bigger the market gets, the more they can monetize with ads. This is something we have heard them talk a lot about over the last couple of quarters, is that advertising is actually a very healthy market in streaming. And that makes sense because people are spending a lot of time streaming content. Makes sense that that would be monetized with something like advertising. What we've actually seen built out over the first decade or two of streaming is really just this segment right here: high monthly fees and a premium streaming service. This is always what Netflix has done. But I think Disney is starting to show the way with streaming. They have included ads with Hulu from the beginning, and they're going to be adding more ads to Disney Plus, and then also, of course, ESPN over the top to support that business. And the strategy there is to get to the biggest market size possible. This is really how Disney becomes a multi-bagger. You go from losing money in the streaming business to being a business that can be as profitable as maybe a technology company or another advertising company, but you have all kinds of ways to monetize, and your funnel is actually bigger because streaming can be global. It doesn't have to be constrained to regions the way that TV is today. So I think really this is the way to think about it. As you go to market size, your biggest market is going to be streaming that's supported by advertising. Your smallest market is going to be parks and entertainment, which is very high cost, but also very high margin. And in between, you have streaming services, which are premium, and then one-time items like tickets to shows or movie theaters, things like that. But the key here for Disney, the way that this stock becomes a multi-bagger, is getting rid of the things that don't fit into this bucket right here, these top two segments. If you're not an asset that is going to be helping Disney sell ads in streaming, like ABC probably isn't, I think those assets will be sold or divested, and the focus will be on growing everything that is going to increase streaming hours, streaming content, and the desirability of that streaming, and the ads that go into it. What Disney has the unique ability to do is build a streaming business that has more content than anybody else. They're the one company that seems to be really focused on getting into sports streaming, and they have tentpole studio content in the way that Netflix really doesn't. And they don't really have a competitor in that space in the streaming business. So you add those two together. If Disney can get the general entertainment side of its streaming business right and try to add more content there, I think you really have a combination that is going to be great for the future of streaming and potentially allow the company to add higher and higher price points and generate more and more money from advertising. I think that's really the key, is that Disney has a lot of flexibility to do different pricing structures if it has enough advertising revenue to coming in to offset what has traditionally been $10 to $15 a month prices for streaming TV. I think there's an opportunity to monetize far better than that, especially in the sports business as Disney builds this out. So what Disney has to do is build that content that people want. Tentpole content, general entertainment content, and then sports content. Bundle that into one great streaming service where they can leverage advertising and then let the flywheel take hold. If they already have one of the biggest streaming businesses in the world, that will allow them to pay more for content than anybody else. And it just makes it harder and harder for everybody else to catch up. So right now, I think Disney is in a lull, but even just the core of that parks and entertainment business is so profitable that it gives a great foundation if the direct to consumer or streaming business improves significantly over the next 5 to 10 years and Disney can build one of the top 2 apps and one of the best monetizing apps through advertising. I think that's how this becomes a multi-bagger. But what do you think? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody.